GameStop is one of the hottest stocks in the news right now, but should you jump in? How did the stock suddenly go up 2,000%? Was it really just retail investors buying it all up? It's not that simple. Let's see how this explosion happened. We see that in a month, GameStop shot up 1,600%, but at the highest point, it went up almost 2,500%. This is a story of how retail investors were able to beat Wall Street. But how did they come up with so much money? Well, actually, it's not that simple. These retail investors served as a catalyst for the explosion in price that happened afterwards from a feedback loop that happens in the stock market. Confusing enough? Let's get into it. These retail investors saw that a lot of people on Wall Street were shorting GameStop. So you can think of shorting like us going to the bank to borrow money on interest. However, instead of borrowing money, they're borrowing a stock on interest and then selling that stock to someone else at the market price, for example, $10, and hoping the price will go down so that they can buy it back at a lower price in the future, for example, $5, and then earn the difference. So in this case, they would have earned $5, excluding any interest fees, which we don't need to go into right now. In this situation, you have a max gain of $10 if the price falls all the way to zero. But if the stock goes up, then you have an unlimited amount of loss, because at the end of the day, you have to return that piece of stock back to the brokerage. So you gotta buy it back at whatever price it is at the moment. For example, if the stock goes all the way up to $20, you lose $10 per short position. There's two important concepts we need to cover in order to understand what happened. First, the price of a stock is driven by supply and demand. So if there are more sellers, then the price will go down. And when there are more buyers, then the price will go up. Second, there's a term called margin call. And in this situation, it means if the price goes up too much, then the brokerage can force you to sell because you don't have enough money to cover your losses anymore. Because remember, you are borrowing the stock. As the retail investors buy GameStop, the GameStop prices will move up because there are more buyers. That forces the people who shorted GameStop, because they are hoping to earn money from the stock price falling, to have to buy the stock to close their short positions to cut their loss. In addition, the brokerage firm will force traders out of their short position as a margin call that I explained earlier if the stock price goes up too high and they don't have the money in their accounts to cover the losses. So as these three things happen, resulting in people buying more and more stocks, it drives up the price higher and higher at a faster pace. And as a result, this is a snowball effect. However, that's not even the whole story. Another way to earn money on the price increase is by buying call options. Without going too detailed, it's a contract that gives you the ability to buy the stock at a certain price, for example, $20, even if the stock went up to $100. So people who buy these call options will earn money when the stock goes up. However, again, in the market, there has to be a seller in order for you to be able to buy one of these options. Just like in life, there has to be at least two people involved when there is a contract. Usually, it's a market maker, which is a person managing the market. So for understanding's sake, we can call them the manager of the market, who is willing to sell you one of these contracts for you to buy. Now, when they're selling you a contract, their risk is pretty much the same as when someone shorts the stock that I explained above, which is unlimited risk. However, their goal is to minimize risk. So what they do is when they have to sell one of these contracts for you to buy, they would buy shares of the stock to reduce their risk, which in turn drives up the stock price because there's more buyers. As a result, when traders see that GameStop price is moving up, they want to buy more call options, resulting in the manager of the market to buy more stocks, making the stock go up even higher, creating another feedback loop. So you can see here that it's retail investors driving the price up, which forces the short sellers to buy back stocks to close their position, which drives the stock up even more. This snowball effect pushed the stock to a certain price where the players who are still short the stock will be losing so much money that the brokerage firm will force them to close their position by buying back stocks, which you can't say no to if you don't have enough money to cover your losses. You can see that happening on the chart where the growth was small to begin with, and then the price started increasing more and more every day at a faster and faster rate until it just blew up. So these retail investors really sparked a huge effect that just spun itself out of control. In the long term, the stock will go back to its fundamental value, which according to Seeking Alpha is around $60. However, it doesn't mean you should get in on this stock because in the short term, anything could happen and the market can move in crazy directions. From this event, it's a real reminder of the risk people need to consider when they short a stock. Doesn't mean shorting is bad, but it just means that you need to know the risk in every trade you take and how to manage that risk. Also, it's really interesting because usually when you buy a put option, you make money when the stock price goes down. Some people have been losing money on their put option even as the stock price went down by a lot. To find out why, subscribe and hit the notification button so you can be notified when the Option Basics video is out. Thank you for watching.